record. Firstly, thank you all for joining us tonight. Investing 101 session 9 of the year. Wow. Okay. It's another session on value investing by Henry. Valuation is going to dive a little bit deeper. I hope you're ready. Quick side note, if you can cue the slide, Henry.
Yep.
Hopefully this will have been clogging up all your social media in the last few days, preferably today as well, because we launched it. But we have launched today Fight 2021, which is our fundraiser together with 60 other uni societies like ours around the country. We have a few hundred students, professionals, alumni, finance companies involved, running, walking or cycling for the mental health charity Mind. I would really encourage you all to sign up because we want to show that we're the best society, and I've just put the link there in the chat for you to sign up. You can also donate via that website. It gives you all the steps on the website. It's really easy, and we just want as many of you as possible to get involved. Look, if I've said this before, but there's 40 of us almost on this call. If each of us gave a £5, it's 200 quid that we didn't have before for a really special cause. We're raising money for student mental health because, as everyone knows, it's all a bit crap at the moment. So yeah, without further ado, Henry, if you've got anything else to add, feel free. Otherwise, get started with your presentation and let's learn about value investing.
Cool, perfect. Yeah, cheers, David. Just wanted to say again, great job to everybody who's been involved in Fight so far. It's been really good fun, and I know all the hard work that David and our society and all the societies around the country are putting for this. I think it's a massive goal. We're almost there with the 10,000 already, so every little penny helps. So, even if you don't like running, this is a great chance to, for 2 weeks to go and get fit. And just raise a bit of money for a great cause. You can all, we can all fundraise together and be part of something really special. So thanks to David and everybody for putting this together. So on with value investing. Where are we at? Disclaimer, we all know about that. I always like to ask this, anybody new? First session, anybody?
I am.
I can see a hand.
Nice, we got a couple of new people.
Hey guys, good to see you. Good to see you. So the way this usually works, just for people that are new, is that I'll run through the presentation, but I like these to kind of be interactive. So I will stop for questions kind of every 3 or 4 slides so we can get a discussion going. This is Investing 101. So whilst we are like 9 sessions in, I do try and keep things basic. There are no stupid questions in this because investing is certainly one of the most complicated things in the world for sure. Anything you want to ask, please feel free. We can also do a Q&A at the end. I'm happy to stay on a little bit if you have any other questions on, specifically related to tonight's content. Tonight we're talking about value investing. So the last session we did was basically a very much basic introduction to value investing. If you missed that, then I wouldn't say there's that much to catch up on, but tonight we're going a bit deeper into those concepts. We always do a book giveaway, which is good fun. So we will be kind of writing down people's names throughout the evening. And the book tonight is the Little Book of Valuation. Very useful book. In fact, here we go. I always seem to have them right here. It's actually here. It hasn't got a cover on it, but it's a very small book, but it's very concise and it has a lot of depth to it and will really help you accelerate your knowledge on value investing. If you kind of want to go over these concepts from the session, we always upload it to our society YouTube channel. That's University of Birmingham Investment Society. So you can kind of watch it back and, just kind of remind yourself of anything in the video. And I've got my own YouTube channel as well. So if you kind of like the type of style of presenting that I do, you want to learn more about investing, stock pitches, personal finance, that kind of stuff, I'd recommend you go check out my channel at H Invests. Okay, so last time we basically talked about this concept of Mr. Market. So we would do our analysis on this company, Wilbur's Whiskey. We'd value the company at a certain amount. In this case, it was $50 a share. And we'd be talking about value investing. We say we buy it when it's cheap, down at 40, and then we go and sell it when it's expensive, up at 60. That's effectively what we were talking about. So, to kind of introduce this session, I thought I'd share a really useful analogy that I just heard the other day. So if we compare value investing to baseball, right? So for those of you who don't know how baseball works, very simple. Somebody throws a ball, you take a hit, and you try and do the best hit that you can. You run around bases and all that kind of stuff. If you get 3 strikes, and which means you kind of miss the ball and it goes back to the what's it called, the wicket keeper, I think. Then you're out. It's not what is it called, mate? The person behind it.
I'm guessing in baseball it's a backstop, but
backstop, that would be it. Yeah. So you're talking about you don't want to get 3 strikes out, right? With value investing, think of it a bit like baseball, but without strikes, right? So there are thousands and thousands of companies in the stock market, pretty much tens of thousands, 5,000 listed on the New York Stock Exchange alone, right? And you don't have the strikes. No one's forcing you to invest in any company, right? Like there are thousands there are thousands in the world, and you only really need like 10 or 15 companies to have a great, balanced, diversified portfolio, right? So you can sit there and you can wait patiently for a great shot or investment to line itself up, and then you can take it on with full force. And what I mean by great investment in this context is an investment that's cheap relative to current market prices. So one thing I would advise for this, once you kind of get a bit more experienced with value investing, is you'd make a watch list. So you would have a load of companies and you would say, I think they're worth this. You would adjust them, but there's no need to adjust them like every single day, because there's just not that much news that really fundamentally changes the value of a company on any given day. It usually happens over time. There's a change in business strategy. There's an annual report that comes out. So what you do is you manage that list and you compare it against current market prices, and you buy the ones that are cheap and you don't touch the ones that are expensive. So here's an example of kind of the spreadsheets that I would build to do this. This may look very complicated. I've basically fixed the first column. This isn't column B, which is why a lot of the information is missing. But you basically just have a target price for certain shares. And then you basically compare it to where it's actually trading, the current market price. That column isn't actually on this screenshot. But then you have the upside or the downside, right? So 71.6% for this stock means that if the stock was to go up from its current market price to where you think it's worth, that would give you a return of 71.6%. And obviously that's what you want to be doing. We also went through the margin of safety concept last week as well, where I said, valuing a company exactly is very, very difficult to do. And in a sense, impossible, right? Because there's always an element of subjectivity. So you only want to invest in companies that are trading at like a really big discount to their fair value. have I got an example on here? Yeah, so for example, like Intel, right? So currently, I think there's 6.7% upside in Intel. Would I really invest in it? Would I risk being wrong for 6.7% of upside? Probably not. But if you look at another company, for example, General Dynamics, and you think, oh, well, there might even be 40% upside here, then there's a much greater margin of safety. And even if I'm like 20% wrong, right, then I still have 20% of upside when I invest in the company. So that's basically the whole idea. This way you can keep track of which companies you think are cheap and which you think are expensive. And then you basically swing those pitches for those companies when they're undervalued. Has anybody got any questions so far?
For anyone that's new here, if you've got a question, either just put your hand thing up on Zoom or drop them in the chat, and every couple of slides, I'll get them across to Henry. So yeah.
Cool.
For the moment, no questions, mate.
Sweet. Ask a question any way you want. Hand up, text in the chat is all right. Feel free to turn your mic on as well. As I said, I'm happy to stay at the end and go through more questions as well. Right, so let's move on to relative valuation. So this was kind of what we touched upon early last time. There were two types of valuation. There's the absolute valuation, where you're kind of like thinking, okay, I think this company is worth 50. And there's also the relative, which is much easier to do because you're just using these ratios to effectively try and work out what the company's worth. And we say relative because we're basically comparing the ratios to one another, right? So you're comparing a ratio of one company to a ratio of another company to work out if it's cheap or expensive on a relative basis. So most of these ratios, they are a function of the company's price or what the market currently allows you to buy and sell it for, and some sort of accounting measure. We did go through a bit of accounting in session 2. I wanted to quickly touch on that now, just to kind of get everybody up to speed with what we're doing. And then we can go along and start looking at some ratios. So with regards to accounting, three key financial statements, right? You've got income statement, balance sheet, cash flow. Again, I'm sure most people are familiar with this, but just to get everybody up to speed, income statement is showing your profit and your loss. Top line is your turnover, your sales, your revenue. Those three are exactly the same thing. And then you have all of your costs. And then eventually somewhere at the bottom, you'll get a net profit. I'll show an example of an income statement in just a minute. The balance sheet, that's your assets and your liabilities, right? What you own versus what you owe. Henry owns a Mini Cooper asset. Henry has student debt liability. Henry has £200 in the bank asset. Henry has a monthly credit card payment liability. It's as simple as that. And then cash flow statement is the actual cash that comes in and out of the business like a bank account. So you have your profit, and then that will eventually flow to the cash flow statement. And then the cash flow statement kind of shows you how the business is spending its profit, right? Like, what are they doing with their profit? So let's go through all of that in a little bit more detail first. Okay, so it's this example. Okay, so it's this slide first, right? So this is how they link together. So a lot of people understand them in isolation, but if you understand how these link together, it can really give you much more insight into the fundamentals of a company. So you've got the income statement, and as I said, the net profits on there, they're received by the business, and then they end up as cash on the cash flow statement. And I say here, subject to changes in working capital. That's because the bottom line of the income statement isn't always the same as the top line of the cash flow statement. So you might be making $1,000 of net profit, or more likely like $1 million of net profit. But then, like, say you might only have a top line on your cash flow statement of 800,000. They're not the same, right? Like, why would that happen? So one example would be, say if some of your customers bought items on credit. So effectively that credit sale has been agreed. That would show up as profit, but because it's a credit sale, you haven't actually received that cash for that sale yet. So it won't turn up on the top line of the cash flow statement. Another example would be depreciation. So depreciation is a concept where assets have a limited lifespan. So effectively, those assets are going to have to be replaced. So in the income statement, what we do is we account for those assets depreciating in value, right? So I buy a factory for 10 million. I think I'm going to have to replace that factory in 10 years' time. So how much is that value of that factory kind of eroding over time? If, say, it just falls to the ground and it's worth zero, then it would erode by 10 million, right? So what would I do? Over those 10 years, every year, I would take off $1 million in depreciation expense because I'm going to have to replace that asset. So quote unquote, that's what happens, but it's not a real cash transaction, right? Because you bought the 10 million factory up front. So that depreciation has to be added back to the cash flow statement. And then, so from the cash flow statement, this then flows to the balance sheet. So the cash flow statement kind of shows the business how they use their cash. Obviously, they can buy things, they can sell things, and then that, if they buy a factory, for example, for 10 million, that factory will then show up on the balance sheet as a factory, it's worth 10 million. So it's 10 million in assets. And they can also take on liabilities. That will show up in the liability side of the balance sheet. And then they can also use this cash to do other things, right? They can pay dividends to shareholders, reward them for profit. They can pay off their debt as well. And then that would reflect in the balance sheet as having less debt. They can also make acquisitions, so they can buy the companies. That would be reflected as an asset in the balance sheet. And then they can also buy back their shares. And then, so we're at the balance sheet now. How does the balance sheet then go back to affecting the income statement, right? Well, you have these assets and your liabilities, and they help the company make money. So then that would reflect in the company's income statement growing. I've bought this factory. It's helped me generate more money. So then my income is going to be higher in my income statement. And then also, what if they took on more debt, right? That would adversely affect a company's profits in the income statement because they have to pay interest on that debt before they get down to net profit. So I basically went through all of basic accounting there in about 2 minutes. If anybody's got any questions on that, please let me know.
Yeah, definitely. I've got a question, if that's okay. If you could choose, yeah, if you could choose one sort of either balance sheet, income statement, or cash flow statement, what one would you choose? What would sum up the company the best?
That's a really good question. I mean, and you know, there wouldn't be a clear-cut answer because they all have their pros and cons. My initial thought, the moment I kind of realized what you're asking, I would probably say cash flow statement because it shows you the real use of what the company's doing. It shows you the company's actions, right? It doesn't just show you how the company's performing. It shows you the company's decisions. I would say probably the income statement might actually be the least useful because, like, sure, you see their turnover, profit, blah, blah, blah. But all of that income statement, the bottom line, the net profit, that is pretty much reflected in the cash flow statement. So you can see the net profit in the cash flow statement. The balance sheet, again, that's incredibly useful. But yeah, I think going forward, the cash flow statement, because it not only shows you like the company's accounts, but it actually shows you like how they're spending their money. Like what part of their net profit are they reinvesting back in the business? You know, are they rewarding shareholders through dividends? Are they acquiring new companies? So yeah, that would be my answer. Obviously, they're all important, but number one, I think cash flow statement would win.
Thank you.
Cool. No worries, mate. Anything else?
Nothing in the chat. I agree with that though. I think if you had to pick one, cash flow, but obviously you can't look at one without looking at the other two.
Yeah, exactly. Cash flow is definitely the one that I spend the most time analyzing because I'm just like, you know, look at the income statement. Oh, you know, turnover's growing, net profit is growing, great. But then the cash flow, as I said a minute ago, you really have to think about it because it's showing you what the business are actually, you're analyzing their decisions, right? And you're analyzing like how they're going to affect their balance sheet and what they're doing with the cash that they're earning. Right, what's next? So let's take an example. Walmart. This is actually, in fact, don't pay too much attention to this example because Walmart is actually, these accounts are a bit outdated. It was just because I could get the first year with, yeah, some arbitrary explanation as to why I couldn't get the most recent year this concisely, but this is how an income statement would look, right? Just very basically, you've got the turnover, then you've got, you know, the cost of the sales, the gross profit. You take off like administrative expenses, so that'd be like paying your staff. It would be like your research and development, you know, for kind of thinking about where the company's heading. Then you've got the operating profit. You have to pay some interest on that. If you've taken on debt, you're going to have to pay interest on that to kind of reward people that are allowing you to lend you money. And then you have to pay tax. And then eventually you come out with your net profit at the bottom. I really should have done this one next. And then, yeah, and then it's cash flow statement. So you have the net profit here. As I mentioned, you would have some changes in working capital if, you know, sales are on credit or maybe sales are on debit, right? Like maybe someone's paid for something up front that they're like yet to receive. You've got your depreciation and amortization, which is usually quite big. Deferred taxes as well. Like you can defer your taxes sometimes. And I wanted to just I wanted to give a little bit of light on free cash flow because this is what we're going to be using later on to actually like really value the company. A lot of people have probably heard of this metric, right? Because free cash flow, these discounted cash flow valuation models are incredibly popular when valuing companies. Why is free cash flow so important? Well, as I said, you know, free cash flow statements show the use of the cash, right? So they're showing you how the business uses their cash, the actual cash that they retain from their profit. Free cash flow is effectively all of this operating cash flow that they're generating minus capital expenditure, where capital expenditure is the money that the business is spending to kind of, you know, keep the business afloat, like replace those factories, you know, put money back into the business. What money does it need to spend to kind of maintain all of its operations going forward? When you think about personal finance, I like to think of my capex as like I've got to buy food to keep myself alive. I've got to pay my rent so I don't go homeless. I've got to pay my utility bills. That's everything to kind of keep me functional, right? And then I kind of have my free cash flow. I could use that to take on new ventures, right? Like I could buy, here we go, some better gym equipment to like get myself in shape. I could buy a better guitar. I could buy some better investment software. I could expand. I could, I don't know, pay myself a dividend, which would be like adding cash to my monthly saving. So that's kind of what the free cash flow is. It's the cash that the business can kind of do whatever it wants to do with, and that might be paying the dividends. It might be buying new companies, you know, buying back its own shares. It might just be paying down some of its debt. It's the actual cash flow that the shareholders can really have access to. So that's why cash flow is important. And then a very basic example of a balance sheet. I'm sure a lot of people have seen this. Assets and liabilities, right? What you own versus what you owe. So this is things like cash, stock, inventory, some intangibles as well. Like if brand value, if Apple kind of value their brand really highly, then that's very significant because there's kind of intangible value in its brand, right? Like, and then there's also liabilities. So that's basically just, what you owe, borrowing, pension liabilities, if you have a pension pot, deferred tax, again, if you have to pay taxes at some point in the future. And if you have items on credit that you need to pay off, that you haven't paid off yet, that's also a liability, right? As I mentioned, credit card debt, student loan, things like that, liabilities. So, okay, that's pretty much accounting 101, all done. Does anybody have any additional questions on that before we move on to valuation?
Yeah, we got a question from Ryan, which is, do you think share buybacks is a good thing?
If they're at the right price, yes. So, okay, I'll explain about share buybacks. So share buybacks basically, if we can see, no, okay, here we go. It's in the cash flow statement. So they've put it here. So share buybacks are effectively, you have the publicly traded shares. The company will basically buy back their shares. That will reduce the number of available shares in the market. And then that will increase all of the metrics per share, right? So earnings per share, dividend per share. If there's less common shares, then those metrics will go up. And then so effectively you're entitled to more like earnings or dividends per shareholder. Do I think they're good or not? If it's at the right price, then sure. Like if the shares are undervalued and it's very clear that they're undervalued, I think share buybacks can be a good thing. I don't think that they should ever be a company's first priority, right? Like if you have this stream of cash coming in, first priority for me would be look at where can we grow the business? Where are growth opportunities? Can we put more into CapEx? Can we buy some new stuff, right? Can we acquire another company? If we can't really do that, then I would go to the dividends. No, then I would probably go to paying down debt. Obviously, that's quite a big priority. Then I would look at the dividends. Can we now use this cash to reward the shareholders? Only then, right at the end, I would consider doing the share buybacks. Like if it's very clear the company's undervalued, great. If a company is buying back its own shares and the shares are incredibly expensive and it's quite clear, doing this kind of analysis that I'm going to be showing you, the shares are expensive. Like what's that doing? It's just destroying value for shareholders, right? Because a company is buying something that's more than it's worth. And I think in that situation, a company just really needs to focus on alternative strategies because the buying back shares when it's expensive just destroys value for shareholders. But if the company is cheap and management have high conviction that the shares are undervalued, then sure, I think buying back shares could be a good thing. Although I don't think it should ever be a company's first priority. And it's not like a sign of organic growth, right? Like the first thing you want to see is a business growing organically, i.e. acquiring new companies, expanding its own business, making more turnover. And then only later down the line, it should really be thinking about buying back a lot of its shares.
Yeah, Henry, just on that point, we've actually got Amrit on the line who wants to add something, if that's
okay.
all right.
Yeah, sure.
Yeah, I fully agree with what you said, Henry. But there's just one point about share buybacks, which is quite important. They're technically, they don't generate any value. So you kind of destroy capital. And you end up with a case that, a lot of the US airlines, I believe it was, I think American Airlines, or maybe it was Boeing. I believe they spent it was Delta. Sorry, I tell a lie. Delta Airlines. They spent 94% of their net income on share buybacks, and then they ended up getting bailed out by the federal government. So there's just that kind of key negative thing, which is that they don't generate any value. They just raise the price of the shares, which obviously is important, and they boost the value of the shares. But there's no actual tangible value you get out of it, as well as the fact that they're actually prior to 1981, they were actually designated as market manipulation, and there's a lot of calls to actually get that back because technically you're kind of use it. The company is effectively artificially boosting the value of their shares without actually doing anything. So there's just kind of that, like, I guess, that headwind for share buybacks. So there's a lot of calls to actually make them illegal again, especially in Europe. So just some points that I thought I'd add in. But what you said is 100% right. If you buy them at the right price, and if they're cheaper than intrinsic value, you're doing the right thing as management.
Cool. Thanks very much for that, Amrit. I really, really appreciate it. I can't believe that. You say 94% of Delta's net income was share buybacks.
I believe so. It was something insane like that. You know what? It sounds so incredulous that like I'm starting to doubt myself now, but
Right.
It was a ridiculous amount.
It might have been with some cash, right? But I don't know. Like it couldn't have been. Like they must have had something better to do with their money. That's crazy.
Well, I mean,
Yeah.
what you end up with is when management is incentivized by quarterly returns and quarterly stock price performance, as well as the way the compensation packages go, they actually are incentivized by the rate of increase as well.
Yeah.
So you're incentivized to actually buy in a bull market where it doesn't make economic sense to actually buy it. And then, you end up buying even more kind of quantities and even more just amounts of money. So it's a very interesting subject, but I just wanted to say they were actually illegal because of kind of the points I said. So it's quite interesting, but yeah.
One thing to add to your last point, mate, is I think this is why it's really important to consider what kind of the CEO's motives are with regards to running a company, right? Like, are they one of these CEOs who's concerned about like a short-term pay package and then like boom, I'm out of here? Like, have they just run a load of companies for like 2 years, or are they the founder? Have they worked at the company for a long time? Do they kind of have the company's best interest at heart? Because if they're just like there to milk as much money out of the company as possible in 2 years by being CEO, then they're much more likely to do things like buy back shares at a high price and reward them, right, in terms of their compensation. But if they're just like a founder and they're really like invested in the company, then they're not going to like bother to get some short-term compensation increase to destroy the long-term value of the company, right? So that's one of the reasons why like taking management into consideration is always really important.
I couldn't agree more, Henry.
Yeah. Awesome. Have we got any other questions, David?
Yeah, we got a good one from Ryan again, which is, what do you think of the argument that dividend payout is basically bad management of company capital, and should they instead be looking to like lower debt or acquire new assets?
So what, just dividends, just the dividend payout in general, having a high dividend payout is bad?
Yeah, I think Ryan, correct me if I'm wrong, but he says looking at AT&T as an example.
Okay. Yeah, AT&T is an interesting one. Like AT&T specifically, because I know the yield's about 7%. I've been really on the fence with that, like, because they're not great from a debt position, right? And like, really, you think the only that 7% yield is clearly keeping their shares afloat, right? Because like the market isn't going to bid down the yields to like 20%. Like the price isn't going to collapse when they're at 7% yield. But then the argument becomes, should they really be doing that when their debt position is increasing and they're forced to pay more and more interest on that all the time? So like a high dividend payout ratio, it really, really depends on the company and what business they're in. Yeah, I mean, I can't think of the exact numbers with AT&T in my head, but it would be nice to see them pay down their debt a bit more as opposed to just focusing all the time on paying that 7% yield. But if they know that if they cut their dividends, then a lot of their value from their shares, because it's an income stock, will fall, right? And then the share price will go down and nobody in the company will be happy. I've been talking again and again about tobacco stocks. So Altria are in a bit more of a better debt position, and they pay out about 80% of their profit as dividends, which I think is fair because they've made some acquisitions. They can afford to do it. They have it all covered by their free cash flow, and they can do it. If you look at Philip Morris, the other kind of main tobacco producer listed in America, who actually doesn't operate in America, they operate internationally. Their dividend payout ratio was close to 100% last year. And even then you think all of your earnings are going to dividends, like 100%. Like what if you want to do an acquisition? what if you want to pay down some of your debt? You just don't really have the free cash flow to do that. So it really depends on the company. For AT&T, I don't know the numbers specifically, but I think given what I know about their debt situation, it would be nice for them to focus a bit more on paying down the debt, and not so concerned with growing their dividends. If you know if they've grown it in 2020, please let me know. I think they held it stable, but I'll be interested to find out.
Well, thanks for that, Henry. No more questions for now.
I've got one more if I'm going to be annoying. So I've just got an income statement in front of me, and depreciation is under operating expenses, just underneath it. So
operating expenses. Okay.
Yeah. So why is depreciation considered like cash if it doesn't like produce any cash?
Why is it considered?
Well, why is it under the bit where it says kind of the cash bit?
Why is it under? Sorry, you mean it's on an income statement?
Yeah.
Yeah, it should be. So like, obviously the income statement is not showing the actual cash. It's just showing the profit and loss, right? And then the depreciation is basically just to kind of like average out when you buy big expenses as a company, right? So like, for example, you know, if I had a manufacturing company and I needed to buy this really complex piece of machinery once every 10 years for 20 million, I don't really want my income statement to look like, oh, everything's fine, everything's fine, everything's fine, everything's fine. And then 1 year in 10, my income statement gets absolutely hammered because I have a 20 million expense. That's what the depreciation does, is it will just even out that expense. So it's like 2 million every 2 million every year, as opposed to 20 million every 10 years. So it's like, it's not like a real cash number, but it just is on the income statement to effectively like normalize a company's profits to like spread that depreciation cost over time. Cool. Sweet. Okay. All good to carry on, David?
Yep.
Cool. Right, here we go. Relative valuation. So, McDonald's. I thought we'd look at McDonald's of all things. Right, so here we have an income statement of McDonald's, just as we kind of looked at with Walmart. And say, for example, we have the net income here, right? So this is the kind of the net profit that the company is making. What if we use that to compare it to the current price of the shares to work out how much a share in McDonald's should be worth? Okay, so what have we got on here? Yeah, so what have we compared it? Yeah, to the number, to how much the total value of the company is. So what we can do is we can look at McDonald's market capitalization. If anybody doesn't know, the equation for market capitalization is basically how much each share would cost versus all of the shares. So if you wanted to buy the whole of McDonald's, like the whole equity value of McDonald's, that would effectively be its market cap. And what we can do is we can like compare these two numbers together. So like we could buy the whole company for 153 billion, and every year, well, for this year, 2020, we would receive 4.7 billion in net profit. So we can use the PE ratio. That's effectively what we're doing here. We can compare the the whole company, and then we can divide it by like how much we're getting in net profit, and we can get a PE multiple. In this case, that comes out as roughly 34. There's another way we can do this as well, because a lot of people might be more familiar with doing it on a per share basis. So you could also look at the stock price per share. In this case, it's $208. And then you could look at the earnings per share, right? So in this case, we have it down here at $6.31. You can take the stock price, divide it by the earnings per share, and again, you get a price to earnings of about $34. Sometimes they do come out as slightly different because sometimes the market cap doesn't always update immediately. You have different metrics for earnings per share, diluted, normalized, adjusted. We don't have to go into all of that, but it's usually roughly the same. And the great thing about this is it's usually calculated all for you. So you can just look at it on a database. So PE is a very, very basic measure of how we kind of can calculate how much a company might be worth. So the way we would interpret this price to earnings, what would it tell us, right? It would tell us that for every hang on a minute. If for every $34 of the stock we buy, the business is earning us $1 in net profit. That's the PE ratio in a nutshell. Has anybody got any questions?
Yeah, we've got one from.
Oh.
Sorry, we've got one from Kadir, which is what is the PE formula?
Oh, it's just here. Sorry, there's two. I should explain this a bit more. So here's the formula, and there's two formulas, but they're effectively the same thing. So the first one is here. So you've got the price to earnings. We're doing the market cap, which is like the total value of the whole company, divided by the total value of all of the earnings. So 153 billion market cap, 4.7 billion in net earnings. That's our PE formula. And then the other way to do it, the reason why they yield the same result is we're just doing everything on a per share basis, right? We're doing how much will it cost to buy the company per share versus how much profit is it earning per share. So that's the other formula you want to be looking at. Does that answer your question? Is that all good, mate?
Yeah, he says, yeah, we've got two more, I think. One from Max, which is quite a good question. I think you actually covered it maybe last session, maybe not.
Okay.
He's basically asking, do you then want a low PE ratio?
Oh, we'll go on to it in a minute.
Cool.
We've got a lot on this.
We've got another one from Amy, which is, how do you know when to use diluted earnings per share versus other like normal basic earning per share values?
Yeah, I mean, to be honest, it's kind of hard. Like, I would only kind of know when to use one if the two were like very, very different, right? So you want to be thinking about, I think diluted earnings per share, in this case, it's useful because it effectively allows for all of the, well, effectively what it is it allows for all of the kind of like options that effectively could be converted into earnings per share. So you want to be looking at that. There's also normalized earnings per share, which effectively that is earnings per share, but it's kind of like adjusted if a company has some like massive one-off expense that it wouldn't usually have, or like, you know, I don't know what it would be, but like maybe it had a load of debt that it was about to pay off and it had to pay loads of interest, or I don't know, maybe it had really high research and development expenses. And like the answer is that there's not necessarily like a one to use that's correct. And in most cases, they're usually very, very similar. So off the top of my head, 2020 McDonald's normalized earnings per share, I think, was $6.30. And here the diluted is $6.31. So if like the two values are roughly the same, I don't really bother because like, you know, P of 34, P of 33.7, not great. If they are all very different, I then look at like what's happened. So like, why is the reported earnings per share different from the normalized? So different from the normalized. What have they adjusted so much for? If the diluted earnings per share is like really, really high, then you have to think about all of those options that could be converted into shares if people choose to do it. And that would happen, right, if the share price skyrocketed. So then that's an implication. So there's not like a golden answer, but I would just say have a look at if they're all really similar. If they are, great. If not, think about why they would be different, and then think about what that tells you about the company.
Great. Cheers, Henry. Just a 15-minute warning.
Okay. Okay. I'll see how we go. We'll see how we go. There have been a lot of questions, to be fair. Okay. So yeah, we've been through this. Okay, here we go. So this is kind of leading into Max's question, I think it was. Yeah. So is a PE of 34 a good deal? Okay, so first thing I wanted to just show was just some historical data of price to earnings over time. Here's .com, here's global financial crisis. The kind of mean PE we're seeing over time for the stock market is about 16 to 17. The price to earnings at the moment for the average of the whole S&P 500, which is the index that McDonald's is in, is about 40. So that's very high compared to the average. A couple of reasons we might be seeing this is interest rates are very low, so people can't get high returns on bonds. Companies' earnings have gone down because of COVID, but the price of stocks has still gone up. Everyone's pumping loads of money into the economy. Everyone seems to think that everything's fine, even though we're in a massive pandemic and there's recessions all over the world. So yeah, we are seeing very high price to earnings ratios, but we can see McDonald's with a PE of 34 is cheaper than the average at the moment. That doesn't necessarily mean that McDonald's on its own is a good deal, but all of that means is that we can buy $1 of earnings cheaper than we can on average in the market. So here we go. When is a low price to earnings a good deal? That's terrible grammar. That of shouldn't be there. So we've got two companies here. We've got David's Dairy and we've got Ethan's Electronics. So we've got just two company scenarios here, right? So David's Dairy has been providing milk and cheese to the same suppliers for 60 years. They get a new supply deal once every 3 years. Market is saturated, no pun intended, devoid of innovation, and growth is roughly in line with local population growth. So, you know, people in the area grow 2% a year. Demand for David's Dairy products grow 2% a year. Meanwhile, Ethan, on the other hand, he's recently discovered an innovative way to improve virtual reality headsets. The market is still young and is positioned for significant growth over the next 5 to 10 years. You know, all of this being equal, would we still pay the same amount for $1 of earnings? If they both had a PE of 10, which company would we rather buy, right? We'd rather buy Ethan's Electronics for sure, because the growth that we're going to see and the potential there is just much greater than David's Dairy, where we effectively just know that the market is going to grow probably 2% a year for the next 30 years with high certainty, but that's all we know. Meanwhile, Ethan has a chance to take a big part in a massive marketplace. So what if McDonald's is expected to grow faster than the average of companies? So what we can look at here is we can look at how fast McDonald's is expected to grow. So if McDonald's has a PE of 34, I'm just going to take that back a minute. If McDonald's has a PE of 34 and the market is trading at 39, but McDonald's is about to go bankrupt and the rest of the market is doing okay, then obviously a PE of 34 isn't a good deal, right? So what we want to look at is we want to look at how much it's growing. So earnings per share of 68% over the next 3 years. If you multiply out these next 3 years in earnings growth, this is what the analysts are forecasting it to grow. We're going to see the earnings per share rise 68% over the next 3 years. So if the price stayed constant, remembering our equation that the PE is the stock price over the earnings per share, if this stock price stayed constant and the earnings per share went up by 68%, we'd actually get a new PE. And that new PE would be 1.68 times less, right? The new PE would be 20.2. So if you look at how much the earnings are growing and you factor that in at a current price, the price to earnings wouldn't look so bad 3 years down the line. That's obviously if the shares are still trading at the same price. If the price goes up, then obviously the price to earnings goes up because price is on the numerator of the equation. And if the price goes down, then the price to earnings goes down, obviously, because price is on the numerator of the equation. So that's the kind of analysis you want to be looking at. Does anybody have any questions on this?
Yeah, we got one from Josh. And the question is, although PE ratios vary between sectors, is there ever a PE value that you deem just too high? Or is it relative, I guess, to other companies, to industry, to the sector?
I mean, yeah, that's a really interesting question. I mean, obviously, relative to the sector is a good way to pay it. For me, as an investor myself, I never like to see a company with a super high PE ratio. Once we're talking above 50 or 60, there's so much growth that's like priced into that stock already, like so much growth. It's just very hard to try and work out if that growth is going to be realistic, right? It's fine if you're an absolute expert in the company and you have really high conviction that that company is going to grow. So I could talk about Tesla as an example, right? Like Tesla's price to earnings is in the thousands at the moment. And unless I really have such a clear vision that Tesla's earnings are going to grow by so much in the future, it's just not really viable. But like, I'll flip that, you know, you've got so many opportunities in the market. If you look at a company with a PE of 15, and it's very easy to work out, right? Like David's Dairy, let's say that's really cheap. Let's say it has a price to earnings of like 6, right? And you know, pretty much certainly milk and cheese demand is always going to remain pretty constant. It's always going to grow at 2% a year. You can value that with much more certainty. So I'd say, yes, high PE growth are justified to high tech companies. And if you can accurately forecast the growth with conviction, then those high PEs are justified. If you can't, and like the PE is implying, you know, these earnings are going to grow by like 200-300%, it's just so hard to know that. It's so hard for the company to live up to its expectations. So when you, particularly when, if you're talking like a PE of above 100, it's usually something that I stay clear of. Yeah. Perfect.
I think if we're talking about value investing though, on the whole, you're probably looking for a low PE, no?
Well, kind of, not necessarily. I mean, you're looking at a low PE relative to what you think the company is going to grow at. I mean, sure, like value investing, it is associated with lower stock PEs, and that's because they do tend to be cheap because the market tends to like overvalue growth companies, right? But there's a difference here. Like, I would still like invest in a company with a high PE if I had strong conviction it was going to grow. Like, the value investing is much more about it being cheap relative to really what you think it's worth and where it's going to grow relative to just the PE on a whole. But usually you do tend to find companies with lower PEs because there's lower expectation for the stock. They do tend to be undervalued more often.
Good man.
Cool.
All right. Keep going.
Let's go. Okay, so here we go. McDonald's, we're forecasting 68% growth in the next 3 years. The median 3-year growth for the S&P 500 of EPS is about 41%, okay? So we're comparing the growth of McDonald's, which is 68%, compared to the market median, which is 40%. Now we're going to do some questions. So we've got the PEG, and this is another formula you can use. It's an extension of a PE ratio. So you've got the price to earnings, and then you've got your earnings growth rate, okay? So this is how much your earnings are expected to grow. That's what we looked at on the last slide, and this would go on the bottom of the equation. So I've got a question if anybody fancies taking a shot at it. So all else being equal, is a high or low PEG more preferable? If anyone fancies taking a shot. No?
Don't be afraid. There's no
No?
Henry won't bite.
No? Okay. Nothing?
We have 2 people in the chat saying low.
Exactly.
Matt and Sibyl and Elliot also saying low.
They're saying low, exactly, because like all else being equal, like imagine if the PE was 1 and I could buy like for every dollar I bought in the company, I get $1 of net profit every year. Also imagine if that company was going to grow at like 1,000% a year, then you know that company is looking amazing, right? I can buy it, I can have all the net profit. The net profit is going to grow 1,000% a year, and that boom, that's going to be amazing. And that PEG ratio it'd be crazy low, right? But that would be amazing. Alternatively, we had a PE of 750 with an earnings growth of 1. That would be really bad for us, and also the PEG would be really high. So a lower PEG is better. Second question, a little bit more complicated. Given everything we've just talked about, what can we infer from McDonald's 3-year PEG relative to the overall market? Like, what can we infer from it? So we saw the PE was slightly lower. We saw the growth rate over 3 years was slightly higher. What can we infer about McDonald's PEG relative to the S&P's PEG over the next 3 years?
Feel free to whip on your microphone if you've got a good answer, or if you want to give it a go.
Maybe we're trying to work it out. Huh? Okay. No? Okay. I'm going to go through it. So first things first, we know the PEG is going to be roughly 2, right? So you've got this price to earnings of 34, and you've got earnings growth of 68%. So 34 divided by 68, boom, like on the nose, round number 2. But then you also know the market had a higher price to earnings, but it also had a lower growth rate. So it's higher on the top and lower on the bottom. So we know that McDonald's PEG is going to be lower or better than the market. And here are the results. So McDonald's PEG is 2. Meanwhile, the S&P is trading at 2.8. So this shows you that where McDonald's price to earnings is, with a lower price to earnings but a high growth rate, that then gives us a better deal for McDonald's compared to the overall market. Any questions?
Nothing in the chat.
Cool. I think we're just going to be bang on time, I reckon. Okay, yeah, we're going to be bang on time. This is perfect. So very quickly before we finish off, I just wanted to go through some advantages and disadvantages of the PE ratio. This is very, very good. Like, as you see, it's very, very good. It's a very basic measure, right? We're looking at price, we're looking at earnings, like two of the most important things when you're buying a company. How much do I buy it for? How much net profit am I going to be getting? There are also a lot of criticisms of it, which is why I wanted to talk about other valuation metrics. We're going to have to go through these next time now, which is absolutely fine. But let's kind of go through the advantages first. So easy to calculate, right? Like we saw that most kind of search engines will give you the price of earnings for you, but you just take the price, you take the net profit, or you could take the price per share and the earnings per share, and boom, you've calculated the PE. Widely used and available because it's a very common statistic. Again, you'll find it out there in the market everywhere. And it's also very easy to interpret, right? So McDonald's PE of 34 cost me $34 to buy the shares, and I'll get $1 of profit for every $34 that I buy. And it's also EPS is widely forecasted, right? Like when you see shares go up and down on earnings calls, effectively what that is that the analyst's forecast of EPS, if their EPS forecast is better than what actually happens, then the shares are probably going to go down. If the EPS forecast was rubbish, but then the company performed very well, the shares are probably going to go up. So EPS, analysts put a lot of effort into forecasting earnings per share. What that means is that earnings per share forecasts tend to be very good. So we can actually do what we did with McDonald's with a high degree of accuracy, right? So like back here when we were looking at earnings per share, these forecasts tend to be pretty well researched. And just a side note, these are the average forecasts of all the analysts, right? And with a company like McDonald's, everyone is following it because it's a massive company and a lot of fund managers are interested in investing it. So the sample size of analysts are very high. So these weighted average targets of earnings per share growth are going to be much more accurate. So let's just go back to this. Yeah, so widely forecasted EPS. Those are the advantages. Look at disadvantage. So one example is it doesn't take into account debt or financial structure, right? Like what if a company is mainly made up of debt to kind of bolster their growth, right? Like it does take into account the interest payments on your debt, but it doesn't take into account how much debt you're using relative to your equity to kind of fund that company. If a company is all funded through debt, then it's not great, right? Because obviously the debt holders, they own some of that company as well. They own some of that cash that's in the business that's being used to generate profit. So it doesn't take into account the debt of that financial structure. Another thing also, who was it I can't remember who mentioned this earlier, but there are different types of EPS that can be used into the calculation. For a lot of companies, they're all very similar and it's relatively easy to calculate. But as I said, companies will take their reported EPS, then they'll normalize it to account for special changes in accounting, and that will be subjective. So that can be a criticism, right? Because this earnings per share can move around a little bit depending on how you want to calculate it. And then also, so net profit calculations can also be very subjective. And another example of that is that depreciation and amortization calculations can be very subjective. Like if you're buying that 20 million factory that I mentioned earlier, some companies might think, okay, I think that's going to depreciate completely over 10 years. So they will subtract 2 million in depreciation expense from their operating profit every year. But then what if another company said, nah, I mean, we're gonna say that factory is going to last 50 years. So now we've got a 2 million factory lasting 50 years. That's no longer going to be that 2 million every year. That is then going to be 400,000, right? So they're going to take off a smaller amount of depreciation. So these earnings, they can often be very subjective. And next time we're going to take a look at these disadvantages and we're really going to go through them and try and find an improvement to the price to earnings ratio and look at other ratios other than price to earnings and PEG to kind of look at our relative valuations. That's pretty much everything from today. I really hope everyone enjoyed the presentation. As I said, be sure to check out our YouTube channel where this will be recorded if you want to go through it again. I appreciate I covered a lot in an hour. If you like what I do, I've got my own YouTube channel, H Invests. I do the financial market stuff. I cover stock analysis on any particular equities that I'm looking at. I will kind of decide if I think it's a good investment or not. I do personal finance videos. If you have any requests for me, then I'll be more than happy to kind of take your request and make a video on it. Fight 2021, as I said, amazing initiative that David and the societies have set up. Really, really incredible. If you're into running, or if you fancy getting fit, or kind of, raising money for Mind, it'd be lovely to have you on board. We're growing in numbers all the time. We're doing a book giveaway now on the little book of Valuation. I believe I said in the chat that we're going to give away 2 books because we have the money and we have the audience to do it. So Ethan's going to spin the dial twice for today. And please feel free to ask any more questions about the presentation. I appreciate I didn't give a chance to ask about content right then and there, but if you have a question, go ahead and ask it now. And if not, I'll hand back over to David and we can get along with doing this book giveaway.
Sure. Firstly, Henry, thank you so much. Another great session. I hope that it was everyone kind of picked up on everything and it didn't go over your heads, but if it did, catch it on our YouTube channel. You can rewatch at your own pace. Really, really insightful. And if you enjoyed it, please show some love for Henry in the chat. Just give him a thank you because it means a lot to him to know that the session is, you guys are enjoying the session. We just had one quick question from Andrew, which is how would you account for the time since the latest earnings report and the PE value? Surely a PE ratio could be more misleading if the most recent earnings report is 2 months old versus 1 week old, for example.
Great point. Yeah, you're absolutely right. Yeah, you're absolutely right. So price to earnings, the price varies on a daily basis. If it's a weekday and the market's open, the price varies. The earnings doesn't. It varies quarterly. That's pretty much the best you've got. Some companies in the UK, they only report every 6 months. Quarterly US, once every 3 months. Yeah, the earnings per share will change, but that's pretty much your best estimate. And that's something that you need to watch out for. The way that you would account for it is that you would look to see, when you're looking at the price to earnings, how much has that price fluctuated since the last earnings report? You also want to be asking why it's fluctuated so much, right? Because when the earnings come out, that's usually the most fundamental information that investors are going to be getting about the company, right? So if you've got the earnings call from 2 months ago, you're looking at that earnings per share, but then the price has gone up 20%, you want to be asking what other factors that management didn't kind of say in the last earnings call have affected the company's price. So yeah, you're absolutely right. Great point about the price to earnings ratio. One of its disadvantages is the earnings per share only comes out quarterly and it's not a figure that kind of varies daily. And you should watch out for like big price fluctuations from the last earnings per share and try and work out why they occurred.
Great. 2 very, very, very quick things before Ethan spins the wheel for the book giveaway. Firstly, Alpha Room we have on Thursday at 6:30. Am I right in saying that, Ethan? Yep, 6:30. Yep. Secondly, Henry, if I can share my screen literally for 1 second. It won't be literally, but it'll be very, very quick. I just want to show you guys something. So this is fight2021.com. We've mentioned it so many times on this call, but it's so important you guys get the message how important this fundraiser is, not just for us, but for students struggling with mental health. So to sign up, you literally type in, as you can see where the mouse is, fight2021.com. You click here, sign up. You put in your name, email, you click Birmingham Investment Society. You choose a distance that you want to commit to over the next 2 weeks, like cumulatively. So for example, 60K, you click sign up now. Then if you want to donate, you click donate there at the top, takes you straight to the Team Just Giving page. As you can see, we've done really well so far in raising over £7,500, and it's day 1 of the challenge so far, which is amazing. You click Birmingham Investment Society, click donate, and all the steps are there. So it is so, so simple. We would love to have you guys helping out, whether you're running, walking, or cycling, or whether you're just donating, or both. That'd be better. Anyway, Ethan, without further ado, spin the wheel and let's see who wins the 2 books for this giveaway today.
Brilliant. So can you see my screen?
Yeah. Who's it going to be? Oh, just Andrea.
Just.
Get in touch with us either on the WhatsApp group, or you can private message me or Ethan, and we will get that book sent out to you as soon as possible. There has been a bit of delay with these books because we've got to deal with the guild every time, but you should receive it within the next week or 2, hopefully. And the second book.
She says, yay, thank you.
You're welcome. The second one is it Oscar?
Yep.
Is it named Oscar? Oscar, congratulations. That is the second book that we are giving away. So well done again. Get in contact with one of us and we will get that over to you. I hope you enjoyed the session. Well done, Henry. Thank you again.
David,
one last thing.
I was just going to say on that subject, can we afford to give away 3 books next time?
We can afford to give away as many books as the people want.
We'll do more book, particularly for the people that are still here. We'll do more book giveaways next time, even more.
100%. I was going to say about the fundraiser, we will also be giving away books, vouchers, big prizes, cash prizes to those of you that run, walk, or cycle the furthest, and maybe even a cheeky one for the couple of people that get big donations in. So get signed up, fight2021.com, and see you on Thursday, 6:30 p.m. for Alpha Room. Cool. Have a good night, everyone.